Hi guys, and welcome back to FutureFunded. Today I'm going to be going through a step-by-step breakdown of points of interest, how they work, how you can use it, and how you can differentiate a point of interest from a high probable point of interest. So let's get in there, guys.
So if we want to start to validate points of interest and what makes a valid point of interest and how do we differentiate between an area where we can say, okay, that's a powerful area, or an area where we can say, hang on a minute, this is an area that we actually want to look to trade from. Because to me and to my edge, there is a differentiation between the two. All right, it's not enough just to have one particular 5-minute point of interest and then go from there and enter. You need a certain entry model that puts the probabilities in your favor. All right, that's what gives you the edge in the market. So if we look at this 5-minute time frame on the euro dollar for an example, okay, so price has been pumping down. We then get a tap at Asia lows. We then literally just tap into it, and then we start a retracement phase. Okay, so now we're going into that retracement phase. We know that at some point, considering the markets overall are bearish at this present moment in time, that price is probably more than likely gonna want to continue its bearish momentum to the downside. All right, but where do we actually find the areas, and how do we validate which area is good, which area is not? Okay, now normally speaking, we will initially have the first area of a point of interest. Now, whenever we have the first one that we see, I'd say that the only reason that I never trade it is because if I can see that, most other traders can see that. Okay, so anyone who's looking at a similar-ish type strategy to me or trades in a similar way, majority of traders will focus on this first point of interest because it's the first area that you see, and there's a bit of liquidity just below it as well, which makes it even nicer, because normally when there is liquidity below point of interest, it does normally make the area a bit more powerful. However, considering that we have just had a reversal structure form here with price action, I knew that in this particular scenario, price is more than likely going to want to break through this, and it's more than likely going to want to trap retail traders, and that's exactly what it does. Look, we see rejection, we see retail traders come, or at least try to come into the market. Price then pushes up. We see it attempt to do somewhat of a fake out, or at least come close to the edge of the 5-minute point of interest, and then sellers try to come in again before institutions start to manipulate once more. All right, so normally whenever I see some form of retracement, the first area, supply and demand area, support and resistance, whatever you want to call it, you know, mine's slightly different. Obviously I don't trade support and resistance and so forth. Mine's just based upon institutional levels, but we can see here just below, or just above I should say, this area of liquidity or a resistance level, whatever you want to call it, we have this beautiful point of interest right here. Okay, so price has now tapped into this area, and this is kind of what I was saying earlier about, I don't just want to enter. All right, I need to see price action actually develop. Now, in the way that I do that, or the way that we teach other traders to do that, is we focus on whether there are multiple areas of points of interest within this point of interest. Okay, because the more that we have, the more powerful it is, the higher probability we have of our trade playing out in our favor. Okay, so the first thing I'm looking for, once we get the break of structure and everything like that, as you can see, we've had a push down, we then had a move higher, taking out this previous high. So now we've got a break structure on the 5-minute time frame. Perfect. The first indication for us is the break of structure. This is how we've got a good chance now that this pullback or retracement phase is potentially coming to an end. And what's it done? It's left behind a 5-minute point of interest. Perfect. Still not enough though. Okay, now, yes, okay, we've got a 5-minute point of interest here. We've got a new 5-minute point of interest which has been created, which not only got created but actually broke the uptrend structure on the 5-minute. But now it's really about, okay, on the 1-minute, do we now have another point of interest that we can focus on? Well, we actually have two. We have one right here, right there, which price through, and we also have the origin, or what I like to call the origin. The origin is where the move initially started. Okay, now if you focus on this entirety of the move that ended up coming down to here before retracing back up, it started from this candle up here. Now, given the fact that we're at a 5-minute point of interest. We've had a break of structure. And then on top of that, we've then made a new 5-minute point of interest. And then on top of that, we've also created a new 1-minute point of interest. This is what I would deem to be a perfect representation of the edge in terms of how powerful points of interest can be. And the more that you have, the better it is. So at that point now, all I needed to do was simply just wait for price to tap back in. I knew that if price tapped into this 5-minute point of interest, I wasn't going to enter. I needed to wait for it to tap into the 1 minute. And that's exactly what it did. So as soon as I saw sellers come into the market, stop above the 5-minute high, not the 1 minute, the 5-minute high. That's really crucial. And then look to target the low. All right. I saw that there was some liquidity down here in the form of equal lows. So I thought that that might be quite a nice price, or that might be quite a nice point for price to go to. Price didn't end up going all the way to there. Price actually came down to here, which was the point of interest, just above it, which was absolutely fine. I had that marked out anyway. So what I ended up doing is I ended up taking 80% of this trade off here and then leaving the rest to run to that area of liquidity. We got there in the end. All right, we got to the 80%, but perfect. Still took out 80% of this trade. It was a 1 to 2.8. So I still took around about 1.82% off of this position. Okay. But most importantly, the result doesn't necessarily matter. What matters is the entry. What matters is understanding the difference between just having a point of interest and then using a combination of multiple points of interest to dictate where you believe price is going to go next. All right. Now, some people like to enter on the first test, including myself. Some people like to see buyers step back into the market, try to attempt to push the price higher, and then fail again, or do some form of sweep. Again, that's absolutely fine. You could have entered here. You probably would have had a better risk to reward than myself. But either way, whether you're entering on the first test or the second test, it doesn't necessarily matter. All that matters is that you're focusing on the areas that we're focusing on. Okay. And as you can see, after that point, price literally just melted down. So I hope that helps, guys. It's really, really crucial to understand and yes, be specific about your points of interest. Whether you use a point of interest or fair value gaps, whatever it might be specific. Only look for clean, clear cut, high probable outcomes. All right. There's no point just looking for one POI or a break of structure. That you need to have more in your arsenal to give you meaning to enter that trade, because at the end of the trade, whether you win or you lose, you've got to ask yourself, why did you enter? And you want to give yourself enough variables as to why you took that trade. All right. And normally speaking, that helps improving your trading journey. All right. So cheers, guys, and I'll see you on the next one.
So guys, I hope you found that useful. As you can see, that was one of the crucial elements that I use to pass my future funded challenges and become a consistently profitable trader, receiving consistent payouts through them. Now, as you can see, you can use this methodology on FX or futures. It doesn't really matter. The meaning and the methodology behind it is always the same. So guys, make sure to like, comment and follow for more content with FutureFunded, and make sure to go to their website, get your challenge and start implementing everything that I've said. I'll see you soon.